We are going to discuss briefly the working capital in this chapter. Current asset is a highly liquid asset that can be used to finance current liability, and normally it does not generate net interest income. Net working capital now is current asset minus current liability. Mostly when we say working capital, usually we talk about net working capital here, current asset minus current liability. Now, current asset includes short-term marketable securities and cash, accounts receivable, inventory, and many others. Marketable securities are considered as cash equivalents, so it is considered as cash if the original maturity is less than 3 months. So even if a bond will mature after a month in your hand, if original maturity is like 3 years, it's not considered as cash equivalent, for example. Inventory includes supplies, raw materials, work in process, and finished goods. Current liabilities are payables and many others, such as tax payables and dividend payables, those payables, and these should be current liabilities should be financed by current assets. Now, marketable securities are held for a short term, mostly less than a year, to provide the funds for operations. Now, current asset investment policies can be relaxed, moderate, or restricted. If the policy is more relaxed, then the company will keep more current assets, such as for the same amount of sale, relaxed policies will keep more current assets than the others. Well, we need to keep in mind that current assets mostly don't generate interest income. If it has more restricted policies, then the company would face limited ability for paying current liabilities, but the company can reduce the opportunity cost of holding money. Holding money is not free, actually, because by holding money, the company loses some investment opportunity and also lose some interest income. Now let's see current asset financing policies. Moderate approach is matching the maturity, and yeah, look at this. Temporary current assets are financed by short-term debt, and the total permanent assets, including permanent level of current assets and fixed assets, are financed by long-term debt plus equity. This matching approach is usual for most companies. Now, if a company finances some part of permanent level of current assets by short-term debt, see this part of permanent level of current asset is financed by short-term debt, it is considered as aggressive. Financing long-term assets by a short-term debt is a risky business because return from a long-term asset can be slow, while short-term debts should be paid back quickly. Now, conservative approach If a company chooses conservative approaches, the company uses long-term finances for all non-current assets, long-term debt plus equity, finances all permanent level of current assets and fixed asset, and some part of current asset also. And then this will reduce the level of risk. Let's see cash conversion cycle. Inventory conversion period plus average collection period is cash conversion cycle, and this is the same as payable deferral period and plus cash conversion period. So inventory conversion period and average collection period together shows from the sale to collection cash for accounts receivable.